kind of small. I hope you can see it. We took what they call an investment quilt, and it's 9 different asset classes. And it's a little bit unfair to do this by adding gold and silver, because these asset classes might be like the S&P 500. We have a cash equivalent, which is T-bills, but a lot of these things are uh, indices, anything from 30 to 6,000 assets. And so they tend to be less volatile than individual assets like gold and silver. But we take that quilt, these are the things that investors can invest in, and we add gold and silver. And you can see, gold and silver being single assets will be more volatile. There are times when they're at the bottom, silver in 2021, silver in 2023. And then there are times when it's at the top, 2020, 2022, 2024. Silver was first, second, and third in terms of over the year performance. The price change from the beginning of the year to the end of the year. Gold is up there too, most years. Last year, gold was the top performer at 27%. Silver was at 20%. Large cap equities was in between that at 25%. Everything else, number 4 was 11%. So gold and silver do well in a diversified portfolio. Turning to the fabrication demand, or the fundamental market, there are now more than 60 billion ounces of silver that have been mined or are estimated to have been mined since the beginning of civilization. And you can see that, by 1900, it was only around 11 or 12 billion ounces only. The bulk of that 60 billion ounces has come since 1900. And at 1800, it was only about 10 billion ounces. So a lot of this silver was mined in the era of modern mining, where good records were taken. You still have this whole issue of, like, do we really think there were 5 or 6 or 7 billion ounces of silver that had been mined prior to 1500? Yes, we do. And then the distribution. A lot of that, 5.5 billion ounces, I'll show you a chart in a second, is in silver bullion and coin form. And the coins you see, 2.3 billion ounces of silver bullion coins that have basically been minted and sold to investors on a net basis since 1985. Another 3 billion in bullion form. And that bullion can be 1,000-ounce bars, 100-ounce bars, 10-ounce bars, kilo bars, medallions. Medallions are basically not official coins. They're rounds, 1 ounce typically, sometimes 5 ounce, sometimes larger, that are not official coins minted by national mints or government mints. Another 26 billion in jewelry, decorative objects, religious objects, stuff that gets sold and melted down and refined into bullion on an ongoing basis. And we try to estimate that with secondary supply. And then half of the stuff has been lost. These are silver CPM groups, silver supply demand balances, surpluses and deficits, net additions, which represent basically investor buying, except sometimes when investors don't want to buy and it shows up that the market makers wind up buying it and holding in their inventories, and net withdrawals, which is investor or market maker selling. You can see these large swaths of buying and selling, buying in the 60s, selling in the 70s, buying in the 80s, selling from 1990 until about 2005. And since 2006, net buying. Those surpluses are calculated in total supply, mine production and secondary recovery, less fabrication demand. We do not include investment demand because investment demand doesn't use silver. The silver that investors buy stays as silver, readily saleable back into the market, as we've seen over the last 18 months. Investors don't use it. It stays in bullion form. You don't count it there. You want to know whether a market is well supplied or undersupplied. relative to fabrication demand, the actual use of that metal. And understand, we say use. Silver, by and large, is not consumed. Most of the silver that is used is recyclable. There is an active recycling industry. There are some uses where the silver is so de minimis that it doesn't get recycled. Mirrors, ball bearings, uh, solders, you might not see the silver recovered from that, although some solders, you will see that. So what we're seeing is a surplus of silver since 2006. And it got very high. It got up to record levels in 2011, 2012. That is silver that investors are buying, bidding the price up. And you can see when the surpluses occur, i.e. 1979, 1980, the price of silver rises. Why is it that you have a surplus and the price is rising? Because that surplus represents investors buying silver. And if there's not enough silver readily available in the bullion market, they bid up the price to encourage increased secondary recovery, increased mine production, and decreased fabrication demand. Surpluses relate to spikes in higher prices. You saw that in 1980. You saw the deficits from 1990 to 2005 related to prices moving sideways between $3.50 and $5.50 for 15 years. Then you saw the price go from $5 to $50 between 2006 and 2011. Not because you had a deficit, but because you had a surplus of new metal relative to fabrication demand due to the fact that investors were bidding the price up, increasing supply, decreasing fabrication usage of silver. Came off for a while, the price, the amount of silver that investors were buying on a net basis also came off. Now you can see here, we have 3 years in which silver, we estimate the net investment demand for silver was more than 200 million ounces. We have several years where it was 170, 180, and those tended to correspond with higher prices, right? Last year, we saw an estimated 70 million ounces. That was up from about 50 million ounces in 2023 to about 70, 72 million ounces last year, and the price of silver was rising. Our projection is that investors may buy more than 150 million ounces this year on a net basis, which could see the silver price rise further. Why do we think that investors are going to do that? Well, we've seen pretty strong demand in the first 2 months of this year. And we look at the economic and political environment, which is the factor. Those are the key factors that cause investors to buy silver. If you look at investment demand in silver in North America and Europe and Japan, also to some extent in China and India and other places, there are some places where silver is used as quasi-money. But for the most part, the investors buying silver and gold are upper income. That's pretty much spread all over. Professional, 40 to 65 years old, relatively reasonable people. And they look at the world and they say, well, inflation's coming back and we have all kinds of political uncertainties. And it looks now like we might just teeter into that recession that people have been expecting since 2001, 2021, 22. Maybe we're going to see that recession in 26, 27. Maybe we'll see a world war. Maybe we'll see increased political problems on an international and national basis. I think I want more of my wealth in silver. So they buy silver partly as an investment based on the fundamentals of supply and demand, but partly because they're worried about the state of the world, and they're worried about the state of the world as it affects them. Now, there are investors who think there's a deficit, and they're buying silver because the world's going to run out of silver, and they're wrong. There are no deficits. there are estimates of deficits, and the Silver Institute publishes some in their World Silver Survey, which they've continued to publish since we walked away in 1994. And over the last 4 years, these are their deficits: 93, 261 million, 189 million, 182 million. Record amounts of silver, 261 million ounces. But they include investment demand in their supply demand surplus deficit calculations. Why do they do that? You'd have to ask them. But the result is that you have deficits. But 284 million ounces of that 93 million ounce deficit actually was investors buying it, keeping it in bar and coin form that was readily able to be sold back to the market should they want to sell. You take out that 284 million ounces from the 93 million ounce surplus in 2021, and you have 191 million ounce surplus. CPM Group's estimate was that it was about 142 million ounces. And that's why the Wall Street silver scam, where they're going to buy up all of the silver on the COMEX depositories, didn't work. Because not only was there a lot of silver above ground already, not only in COMEX inventories, but elsewhere, but there was 142 million ounces of newly refined silver added to that pile. And you can see the same thing. You take out the investment demand from those deficits, and you've got surpluses. And you've got surpluses that are actually pretty darn close to CPM Group surpluses. And that's Commodities Research 101. The deficits disappear if you realize that the silver bought for investment purposes is not used. It's held by people, many of whom are actually investors. And they're going to hold silver on a short-term or a long-term basis. There are no deficits. They disappear when you do your math right. I'm sorry, you do your arithmetic right. There are, as I said earlier, 5.5 billion ounces of silver in refined bar and coin. The green stuff is the coins. You can see it really started around 1984, 1985 with the creation of the Royal Canadian Mint and the U.S. Mint silver coins, silver maple leaf and silver eagle. We're proud to say that we were involved with the creation of both of those silver coin programs, as well as other coin programs. And then the other thing is that stuff at the bottom, the lavender stuff, those are exchange-traded products, mostly exchange-traded funds, but there are some exchange-traded notes and bonds that have physical silver behind them. And that's like 1 billion ounces now. And then there's this vast amount of silver that is estimated to exist that goes unreported because there's all that silver. Where'd it go? Well, some of it was bought by investors, and those investors didn't report it. And they still don't report it. They don't want to report it. There's a lot less in that form now because a lot of investors have shifted their holdings from bullion bars to coins or from bullion bars to ETFs, which both have advantages to 1,000-ounce bar for storage and for purchases and for sales. So the world's not running out of silver. And toward the end of the slide presentation, I have the reserves, the mineable reserves and reserve base. There are actually no deficits, with silver being refined more from mine production and secondary supply refining every year. Fabrication demand doesn't use it all. It goes into the world's inventories, which are primarily owned by investors. As a result, when people ask us, and one of the questions that we got several times was, how many years of deficits before the world runs out of refined above ground inventories? You honestly can't answer that because there haven't been deficits. If there were deficits, you could say, okay, we have 5.5 billion ounces of silver. Let's say there's a 100 million ounce deficit. That's going to take, 55 years to run out of? But there aren't deficits, there are surpluses. Every year, investors add more silver to their inventories. And there's this weird psychology there too, which we probably won't go into today, the way investors look at it. I'm thinking about silver as a fabrication demand commodity, commodity used in all kinds of applications. And that's what really excites me. But the price rises because I'm buying silver as a financial or quasi-financial asset and holding it in silver form. So the silver price is rising not so much because fabrication demand is rising, but because I'm buying it in the expectation of higher fabrication demand. It's not the only place where you'll find cognitive dissonance in the way people think. Now, as I said, you saw investors selling coins and bars over the last 18 months, really starting around the middle of 2023. And that's reflected in the premia that you see for those things. We had seen the premia for silver eagles, running a little over 10%, 10 to 15% from 2012 into 2019. It shot up. The eagle is perhaps not the best representation, but it is the silver coin produced by a national mint that actually publishes monthly data. So you can see better what's going on there. And the U.S. Mint had production issues that made the silver eagle current production more, it had limitations on it that other mints didn't have. But you saw the silver premiums rise starting in the second half of 2019. So this is not Wall Street silver. Wall Street silver came along in 2021 after the premiums had gone from 10% to 40%. And then they came back down during the COVID lockdown to close to 10%. And then they went back up to 40% after the lockdown, after the recession, in the economic recovery as inflation was picking up. And scam artists came into the silver market saying, oh, we're going to run out of silver. And some people were foolish enough to listen to them and believe them, and probably are still listening to them as they say that. Then the premium for coins, eagles, shot up to 80%, and now it's back down a little bit below 10%. And you saw a similar pattern for bullion bars, 100-ounce bullion bars. That's an indication of the two-way market for retail products. Some investors are buying, driving the price higher. Other investors are saying, if you think that silver is worth $32 or $34 or $35 an ounce, here's my silver. So you've seen a lot of selling, and that actually has caused some coin dealers and bullion dealers, dealers, to back up and say, yeah, I don't want to buy this kind of silver. I don't want to buy medallions anymore. I'm going to only pay you like 3% less than a spot price, whatever spot price I happen to say the spot price is. You're seeing a backup of silver investment products being sold.